Hi everybody and welcome to March's Mover Masterclass. I'm delighted to have Brock Harchler with us today. So Brock's from ProMover Accounting, which is a bookkeeping accounting firm for moving companies. So super excited to have Brock here today. I'll hand it over to you.
Thank you so much, Claire. And I live and breathe this stuff, so I'm super excited to share it. So, five essential of accounting. Starting off, why is accounting essential, right? Well, five major reasons. Taxes and lending. Okay, that's the boring stuff. Then what we call plugging the holes. This is the more exciting stuff. And finally, reporting and projecting. And this is the very exciting stuff and the real secret to many businesses' success. We're going to get to each one. So, starting off with the kind of boring stuff, taxes, right? We are to render unto Caesar that which is Caesar's, right? So, if you're doing business in the US, we owe taxes to Uncle Sam for having the right and the privilege of doing business here. Now, you can stop there and pay what your TurboTax program is telling you that you owe to the government on April 15th, or through accurate accounting and a good tax accountant, you can leverage the laws to your advantage and limit the amount that you owe each year. This is where hiring a good accountant can pay for itself alone, right? Now, immediately when I mention a good tax accountant, everyone jumps to find a certified public accountant or a CPA to do their taxes. And while that's a perfectly fine way to go about it, we always recommend finding a non-CPA tax accountant locally that you can build a relationship with and that puts you and your tax savings first. Also, there are going to be most likely they're going to be significantly cheaper than a CPA. It's important to note that your tax accountant and bookkeeping firm doesn't have to be the same firm. A firm that specializes in bookkeeping may be superior to a bookkeeping or tax, may be superior in bookkeeping to a tax accounting firm that specializes in tax. So here at ProMover, we are not a CPA firm. We do not file taxes on behalf of our clients, of any of our clients, because we want to be the best at what we do, which is financial reporting, bookkeeping, and metric analysis. For residential moving companies. At the end of every year, we bundle everything up for our clients, CPA or their tax accountant, and everything that they would need to file the taxes for the company, and everything flows very smoothly. So on that thought, there is a little known fact that there are only really three main differences between a CPA and a non-CPA tax accountant. And the first being CPAs are licensed through the AICPA here in America after meeting certain criteria and taking a very difficult test. This basically goes to say that they know a vast array of knowledge about not only tax, but also financial reporting, business concepts, and auditing. Those are the four portions of the CPA test. CPAs can represent you in court. So if you get audited by the IRS and you're required to present financial information to a judge, only a CPA, attorney, or an enrolled agent is able to do that for you in place of you. I want to say that they have a fiduciary responsibility to be able to represent you. Whereas if you have a non-CPA, they're able to be there with you, but not able to represent you, if that makes any sense. And the third thing, CPAs can provide you with audited financial statements. Now, we have seen this mostly used with very large companies. Obviously, public companies have to get audited. They're audited throughout the year. Governments and municipalities get audited, but not too often outside of that. Possibly if you're selling a company, a buyer may want to review audited financial statements just to verify the validity of everything in those statements. But again, generally, this is used in instances of large sales for the most part. A lot of our clients, moving and storage companies, residential moving and storage companies, never see an audit in their business's existence. Now, I really say this to say that not all tax accountants are created equally. There are good accountants and bad accountants, CPA or not. It really comes down to the quality of their character and how hard they're going to work with you and for you to lower your adjusted gross income, because ultimately that's what helps you reduce your tax liability. So taxes. The next thing, and the second essential reason for accounting, is lending. Okay. The only way to have access to cheap leverage is by providing a lender with strong, accurate financial statements showing positive cash flow with equity and collateral to lend against, right? I'd venture to say that a majority of our clients, prior to having good financial statements, receive a shark loan of sorts or a high interest loan in some shape or form because of the risk that they represent, right? The risk that's presented to the lender. And because of that, the interest rates are going to be higher to cover that risk. So having good financials vastly assists in banking and underwriting relations. And it's really a necessity if you want to scale your business in any way, right? Now, one thing that we see most moving companies not taking advantage of is a business line of credit from a bank or a similar lending institution. We all know the moving industry ebbs and flows during the winter months in different parts of the year, and a line of credit, in my opinion, is the best way to help fund your cash flow shortages during those winter months. They generally have a relatively low but variable interest rate depending on your overall risk. And the payments are also pretty low, sometimes with a 20 to 30 year amortization, depending on, again, your risk and what your lender is willing to do for you. Again, though, it's going to take clean, positive cash flowing financials to get a credit line. So make sure you have an accountant that can produce good financials that show a lender the information that they want to see, and not just the information they want to see, but it's clear and it's precise. Okay. So now we get to the real why of accurate financial reporting, which is plugging the holes. And I know this is a little messy slide, but we'll go through it a little bit, and I want to show you why it's that way too. So plugging the holes. So we know that accounting is necessary to do your taxes and assist you with getting cheap leverage, but day to day, why is accurate financials necessary to me, right? To you as a business owner? Well, every successful moving company owner that I know of started becoming truly successful once they started to get to know their numbers, right? We use the phrase plugging the holes, as you see here, because your company is like a barrel of water with revenues of water flowing into the top and then expenses of water coming out of the holes in the side, right? Most owners think that if they simply add more water or more revenues into the barrel, that will help them walk away with more money. But in reality, more water just ends up flowing out of the holes, and they end up with nothing more than what they started with. So this is where our company, ProMover Accounting, really shines and was the whole purpose of why we started ProMover Accounting in the first place. So first off, you have to start with accurate information. That's the bottom line. If your labor expense ratio, for instance, is showing 20% of your total sales, right? That's fantastic. We like companies to be less than 35% and you're at 20, right? So instantly you seem like your labor expense isn't something that you need to worry about. However, if that number isn't accurate and some of your labor wages is actually flowing into an administrative wage line item, or we have even seen it being paid, some of the wages being paid through owner's draws, which is on the balance sheet, that's not even on the profit and loss, that may actually be a giant hole in your bucket that you can't even see, let alone find if you're even looking for it. So once you begin to know your true numbers, your accurate numbers, you'll be able to see those holes and correct them, which is ultimately going to increase your net. And that's the name of the game. Increasing your net income. What are you walking away with at the end of the day? That's the name of the game. So start with accurate numbers, review those numbers on at least a monthly basis, but then how do you know if those numbers are good or bad? Again, this is where ProMover is outstanding in the industry, right? We only service residential moving companies. So we've been able to produce our own metrics and compare your company against that metric and give you a target to shoot for. So one thing that we found when we were starting ProMover is that a lot of the metrics that business owners would use to value their company were based on metrics that they found online or metrics that they heard of from somebody else. And specifically in the residential moving industry, a lot of those metrics included van lines. Now, as we know, van line companies and residential moving companies are vastly different. One example is advertising expense for van lines doesn't have to be as high because they have jobs and sales that they can pull from a portal, whereas opposed to residential moving companies don't get their sales from a portal. So advertising is a little bit more necessary, and we like to see more of an advertising expense in the profit and loss in order for someone to scale and grow their company. We like to see 7 to 10% of total sales go to advertising, right? So either way, each month for our clients, we produce a report that we call the Pro Metric, which shows in green and red how you can perform, or how you performed within that metric for the month. And that will tell you what you need to work on, right? So you can see in this slide here in the background, you can see this as a real life example. This is actually a client that I pulled his Prometric down and obviously hit his names for security purposes. But this is actually what one of our Prometrics looks like. So this Prometric, for example, for the end of the period, his gross profit percentage is 49%, which is perfect. Right at 50%, that's what we're looking. Now it's red, and obviously the formula is anything below 50%, it's going to pop up red. But having an open mind, you can see that he is right where he should be as far as gross profit percentage. You can even go down and look at that and see the net income percentage is 22%. That's fantastic. If your moving company can have a 22% net, that's absolutely fantastic. That's what we're shooting for all of our moving companies. So again, to summarize plugging the holes, you need to have accurate financial reporting in front of you to know which holes you need to plug to grow your moving company. But before trying to simply increase your sales, look at where you're over expending funds and plug that hole. That's bar none the best way to increase your bottom line. You can pour as much water into that barrel, but until you start plugging those holes, water's going to keep flowing out. So plug the holes. That's the best way to increase your bottom line. All right, next, financial reporting. And this is where I live and breathe every day. So we talked about the necessity of having accurate financial reporting. If your reporting isn't accurate, there's really no point in even evaluating your reports, right? So barring your reports are accurate, there are three main reports that every moving company should be reviewing and understanding every month. And those are the balance sheet, the profit and loss, and the statement of cash flows, right? I'm not going to go into detail about each report, but I do want to highlight the importance of each one and some of the things you should be looking for in each one. So the balance sheet, right? The financial equation for the balance sheet is assets minus liabilities equals owner's equity. So this report is a periodic report, meaning you don't look at the balance sheet from January 1st to December 31st, right? You look at this report as a snapshot on the date December 31st. What's your balance sheet say, right? What's that asset value at December 31st, right? Now, the overlying purpose of this report is to display the equity that you, the business owner, have within your company. That being said, the most important item to look at from a 30,000 foot view is total equity. And obviously that's the sum of this report. Assets minus liabilities equals owner's equity. That's the bottom line. That's what you're trying to get to, and you're trying to increase that owner's equity. Okay. So total equity is going to tell you the value of your assets, net of liabilities, and then it's going to add in any retained earnings that you've kept over the years to date for this report, right? So super important. This report should be evaluated every month. Next is your profit and loss, or your income statement, which is revenues minus cost of goods sold minus expenses, and that's going to equal your net income. Now, while many people evaluate a company on total sales, again, like we talked about, holes in your bucket, really the net income at the end of the day, that is the end of the story. What is your net income? That is an important piece, right? We've seen companies with $2 million in sales that are less profitable than companies with $500,000 in sales. And it all comes down to that net income. If you have $2 million in sales and you have $2 million of expenses, you don't walk away with any money. But if you have $500,000 in sales and only $200,000 of expenses, you're walking away with $300,000, and that's the end of the game. So also to mention, probably 90% of my clients that we take on who had a CPA or another bookkeeper performing their books don't get into cost of goods sold. They don't use the cost of goods sold accounts to their maximum potential. Cost of goods sold is an incredible section of the profit and loss. I think the most undervalued. A lot of people just skip it and say, we'll put everything into expense. But cost of goods sold it has an incredible value within the profit and loss, because it allows you to determine your direct expenses and really nail down the amount of money it takes to earn revenue. So cost of goods sold are things like direct labor, right? Fuel expense, packing supplies, valuation damages, right? That's something kind of unique to the moving and storage industry. All of these things directly tied to specific jobs. Those are the cost of the goods that you are selling. Okay. So when we evaluate this within our Prometrics worksheet, we can see the gross profit margin, which is the revenue minus the cost of goods sold. And we want that to be 50% or more. On the last slide, we could see that they were right at 49%, and that's great. That's the number we want to look at. and that tells us information. Most of all, we want to get information, right? So your cost of goods sold is what you are using to earn revenue. Okay, so we want to split those out between cost of goods sold and expenses. We don't want to lump all of our expenses into expenses. We want them to split out between cost of goods sold. Now, going back to this gross profit margin, this is a super simple metric to evaluate. But again, you can only evaluate this if your financials are accurate. And if you evaluate it and they're not accurate, it's almost worse than not evaluating it, because you're evaluating it with misleading information. Okay. So we see all the time that a client's gross profit margin is 75%, and they don't understand why they're not making any money. Well, when we dig deeper, we see that some of their wages may be booked as an expense, right? Not as a cost of goods sold. And their truck rental expense is also going to expenses. It's not going to cost of goods sold. So again, metrics alone won't answer your questions. The data supporting those metrics, that's what's important. Okay. And again, I'm not going to get into all the metrics we evaluate, but seeing how just this one metric can help you make decisions, you can start to see how exponentially useful accurate financial analysis can be, and how important it is that the data that you're using is 100% accurate. Okay. And then finally, the last report, the statement of cash flows. And this is the report that reconciles both the balance sheet and the profit and loss. A very underused statement and a very misused statement, but also very, very equally, I would say, important. So this report takes your starting cash balance for the period, let's say the beginning of the month, adjusts for the changes in balance sheet and profit and loss items, and then reconciles to the ending cash for the period or for the month. So that should be your bank balance, barring no outstanding items at the end of the month. Okay. So the statement of cash flows is incredibly useful, and should really be studied. Every month it should be studied, because this is where you can get some important information that helps you really know the meaning of your net income. So putting it all together, simply evaluating just one of these reports isn't enough to truly get the true story, the behind the scenes story of your success and your profitability of your company. Okay. You have to look at each report independently and make decisions based on the whole story, not just one report. Okay. And then finally, and I'll end with this, projecting and funding growth. And this is probably the questions we get most often, is how to do this. Okay. And this is very, very in depth. And this is what we help a lot of clients out with. Okay. So the whole purpose for financial accounting is to see your company through the lens of profitability, and to adjust accordingly to continue the positive progression of that profitability. And to do that, growth needs to be planned accordingly. The companies that we see grow the fastest do so by projecting their needs ahead of time. And a large determining factor for projecting growth is generated from accounting. Now, not all of it, but a lot of it is generated from accounting. For example, here's a super simple budget for a moving company. This is something that we worked up just for example's sake, but is based on real life metrics. Okay. And we take into consideration various metrics that allow us to project cash flow needs as well as personnel needs. And that's very, very important. Now we can see that towards the beginning of the year, only 6 crew members are needed, but more than double that is needed in July. Obviously, the busy season's getting closer to July, August, September, right? Had we not planned accordingly, this company very well could have had 8 employees in January unnecessarily, increasing the cost of wages towards the beginning of the year, and maybe only 13 employees in July, because they didn't know how many employees they were actually going to need during that busy season. Now, they probably would have been paying a ton of overtime in July, because they have 2 less people than they actually should have had. Errors are going to occur because the employees are tired, and the company just suffers overall because of lack of simple planning. So also we can see that the cost of goods sold is increasing, right? So if we're looking at this report, we can see, and it makes sense, as sales increase, your cost of goods sold is going to increase, right, throughout the whole first half of this year. And in knowing this, there is a need for cash in excess of regular cash flow, because the cash coming in July may not be collected in July. Okay, the cash receipt, the sales received in March may not be collected in March, so we're not able to use that revenue to pay for March expenses, or the revenue in July to pay July expenses, unless you are receiving the cash when you complete the sale. And this is where a line of credit really shines and continues to allow for growth and expansion at a low interest rate, I should add as well. We can also see the projection of ad spend based on historic marketing ROI, right? Return on investment for your marketing. In knowing the average revenue per job, and the number of jobs needed to hit a certain revenue mark, right? That's the projection you want to see. You want to hit a certain revenue mark, thinking that you have a 20% net, you're going to walk away with 200 grand, right? At the end of the year. We can project the cost of ad spend needed to generate the number of jobs desired to hit that revenue mark, right? It's also important to note that ad spend isn't associated with the month the revenue is projected to be earned, right? Generally, we want to project ad spend in the month prior, okay, to then have an impact on the next month, right? You're kind of figuring it a month in arrears. But since the ROI of marketing is never in the same period, you kind of have to think about it that way. It can be anywhere from 30 days to 1 year in the case of SEO, right? You're paying for search engine optimization in January. You might not get an ROI on that until November. Okay, so you kind of have to use some outside of the box thinking in order to project your advertising spend to get the revenue and the jobs and the leads that you need to get the revenue that you want, right? So this is kind of a detailed way of showing that accounting is used in so many ways to grow your company, even run your company the way that it just needs to be run. So I guess to summarize everything back up, the importance of accounting and financial reporting cannot be overstated. Of course, we may be slightly biased, but any business owner that is successful, any business owner that any of you know that is successful in the slightest, can agree that accounting is the building block of success, and knowing your numbers is the building block of success. So I hope I articulated the importance of accounting and why it's essential to the profitability of your business. But if not, hey, I'd love to have a conversation with anyone looking to find out more. ProMoverAccounting.com, and we'll see what we can do. So.
Awesome, Brock. Thank you so much. That was super helpful.
Sure.
I'm sure everybody really found that helpful. We just had a couple of questions come through
Sure.
when we were talking, so I'll just read them out. So the first one was, what is one of the biggest misconceptions you see when talking with business owners about their financial reports?
Sure. You know, there's a lot of things that a lot of people just have questions about, because accounting can be a very, very hard thing to understand, right? And what I would say, the biggest misconception is net income isn't a true representation of your bank balance, right? It's not a true representation of the money that you're walking away with. And here's why. If you buy an asset in January and you don't depreciate that asset in January, right? If you look at it on your profit and loss, that's not there. The expense isn't there, and you have a net of say you broke even that month. Okay, that's great. However, your cash decreased $50,000 because you just bought a $50,000 truck. Okay, that's not going to show up in your net income. So people look at their net income and they say, "Hey, I have a gain, but my cash continues to shrink." Well, that's because net doesn't tell the whole story. You have to look at all three reports, and you would find that if you looked at your statement of cash flows, right? That's all going to be hidden in your statement of cash flows. So.
Awesome. So the other question was, a lot of business owners struggle with paying their laborers a W-2 wage or the 1099 contractors. Is there a surefire way to know which is appropriate?
Yeah, you know, that's a fantastic question, and we get that all the time. And here's what we say. Obviously, we're always going to say, you know, go to your tax guy and ask him, you know, what he would suggest. But especially businesses that are starting out, the hours for their laborers ebb and flow tremendously. Some days they don't have work, some days they do have work, and it can go a week or so without being able to provide work to your laborers. And in that case, we say, if it's not something steady, they don't have a 9 to 5, and they kind of, you know, work when they need to work, we consider that a 1099 contractor, and the IRS would have a tough time arguing that. Okay. Now, once you're getting more sales and you have guys that are coming in every day, and you know they're not pretty much 9 to 5. They need to be W-2 employees. There are people that try to extend that 1099 contractor payments out for a long time. But most of the time they need to be paying some of these guys W-2 wage. There's different business structures that really assist in how that all should work, because there are perfectly valid times where you could have, I know I'm thinking of a company in particular that has 3 million in sales every year, and all of their guys are 1099s. And the reason is how their business is structured and how they're doing kind of over the road laborers, where one man actually owns a truck and he has his team and whatever. Now, he might have to pay his guys, 1099s or W-2s. That's up to him. But for you, that is 1099 contractors is a 100% valid reason to be, or valid way to be paying them. So again, it's really up to your tax guy. Talk with him, consult with him. But that's kind of the 30,000 foot view to say, yes, I should, or no, I shouldn't.
Okay, awesome. Thank you. And one final question, how do I know if my bookkeeper is doing a good job or not?
Yeah. Okay. Well, I tell you what, I think the big thing with that, if you have to ask the question, they're probably not doing a good job. That's what we say. We all the time we get people calling, and to be 100% honest, we are very, very much not the cheapest bookkeepers. I would argue we might be the most expensive. However, people come to us with a bookkeeper and they're not getting the results that they want. And we say, you get what you pay for. And if you're hiring a bookkeeper for $150 a month, when in reality, it probably, would cost us $800 a month, you're probably not getting the reports that you want to see. And then why even pay them if you're really not getting anything for it? You might as well at the end of the year just give your bank statements to your tax accountant and let him do it. So kind of something along with that point too. A lot of our clients like to say, hey, you know what? We're the best mover in the industry. We are not the cheapest, but we will take care of your stuff. We're going to give you good customer service. We're going to be the best, right? And I find it really funny when those people don't want to pay more for valuable products, because it's like, you know what? You see the value of good customer service, and you see the value of just doing business the right way, right? So what I would suggest, if you aren't sure if your bookkeeper is doing a good job or not, I would say, what information are you getting from them that allows you to make decisions, right? And if you can't make decisions on the information they're giving you, then they're probably not doing the job that you need. And something else that we do is we take meetings all the time with people and talk through that. Not even clients. We just want to talk to them and basically say, here, you know what, this is what you should be getting, and this is going to help you run your business. And even if it's training them to help them do it themselves, because maybe they can't afford a premium service at this time, they're a new company or whatever, we're more than happy to help and just say, hey, do this to get you on the straight and narrow. And then when the time comes that you want to make that investment, we're here to help. So
yeah, that makes sense. Okay, well, thank you so much for your answers to those questions. I think we're just at the end of the time. So any other questions, we'll just kind of we'll email anyone after. Thank you so much. That was super informative. Great to have you on. Yeah, we'll talk soon.
Thank you so much, Claire, and thank you guys.